Hello and welcome to this Thursday's morning market briefing. We've got lots to talk about, but firstly, the Bank of England warns about risks in private credit and leverage lending, as well as that oil slumps to lowest level in 5 months despite OPEC plus production cuts. We've got lots to talk about in the charts, also with lots happening on economic calendar. We'll come to that near the end, so make sure you stay around till you see that. Before we get straight into it, make sure to subscribe. The first article to talk about, of course, is the Bank of England. Now, the Bank of England warned private credit and lending markets stay vulnerable to sharp revaluations, and this comes as the Bank of England's latest attempt to sound alarm bells about the growing risks in non-bank finance. Now, obviously, the main topic of discussion whenever we come over, the Bank of England or the Fed is, of course, usually just talking about interest rates. However, a key role of the central bank still remains that kind of looking over financial stability, even though other kind of institutions are supposed to look after that. It plays directly into kind of monetary policy creation, and therefore it's very important to stay on top of it. And so here we are seeing the Bank of England highlight these risks to finance as we kind of emerge into a period of unknown, this kind of uncharted territory following the 2008 financial crisis, where we kind of had this low interest rate era, and then we kind of encountered the COVID pandemic. Interest rates went even lower. And, following the COVID pandemic, we've now seen, inflation rates go above 10% even in the country of Britain. And therefore now, the Bank of England, as does many other central banks, they have to all kind of respond to this changing kind of condition within financial markets. And this is kind of another comment on those changes that we're seeing and the risks associated with them, and therefore the things that need to be looked out for by regulators and by just individual market participants, of course. And so it's kind of interesting to start to hear about these risks that the Bank of England are, of course, highlighting in these growing issues. Now, the two sectors facing significant headwinds, according to the Bank of England, are given with the two sectors facing significant headwinds given interest rates and persistent inflation and increased uncertainty about the long-term economic outlook, according to the Bank of England, is the private credit and leverage lending markets. These are two industries which two sectors which according to the Bank of England is at great risk, most definitely. And these comments followed similar statements by his financial stability experts who warned of economic fears driving sharp revaluations of credit risks, with Andrew Bailey, of course the Bank of England governor, warning that regulators had to keep a closer eye on the non-bank financial sector since it had grown so much since the 2007 to 2008 crash. And this is coming back to what we were just talking about, is these kind of risks to the financial market that didn't exist before, really, and now markets are having to respond to them adequately. Now, Bailey did also point to hedge funds ballooning bets on US bonds, which could also result in significant market volatility and tighter credit conditions in the event of a shock, with the Bank of England data showing hedge fund short positions in treasuries, obviously that being US bonds, being bigger than they were in the run-up to March of 2020 when there was the dash for cash. That said, some pressure on asset valuations has been relieved since US bonds have been falling sharply in recent weeks as lower interest rates are priced in. And this is what we've mainly been talking about in reference to central banks, in reference to the dollar, and in reference to the global economy as a whole. Is this kind of this kind of decrease in inflation, where inflation's been coming in under expectations, and therefore kind of creating this new optimism about having lower inflation within the US economy. And therefore this has kind of triggered those individuals within the market to begin pricing in earlier rate cuts than previously expected. And we've been covering this greatly since, the US inflation figure did come in below economists' expectations greatly the last time we heard, and as well as that, lots of market data has also been referencing and kind of pointing towards a kind of lower inflation economy, and therefore people are undoubtedly going to start pricing that into markets, and that's what we've been seeing. And so this is kind of what we've been mainly talking about, and we've seen this reaction in US bond yields as the article is referencing. Now, the Bank of England has recommended that liquidity requirements for money market funds should be doubled to reduce the change of the chances of a forced sell of assets as seen before. So keep your eyes on this most definitely, as these risks are growing as we enter a new kind of financial era following COVID, and now long gone from the 2008 financial crisis, but still kind of the cloud, or at least the the remnants and the memories of that financial crisis still hang true within the financial industry. And that's why we're seeing kind of these risks now be highlighted in an effort to kind of look forward in a more positive manner, but also highlight these potential risks that need to be regulated. But that's all to talk about in this article. The next article to talk about, of course, is oil slumps to lowest level in 5 months. Now, oil prices have dipped to their lowest level in 5 months, and this comes as investors grow skeptical that production cuts announced by OPEC Plus last week will be enough to offset rising supply from countries outside the cartel. Now, we've been covering oil somewhat, most definitely, and we've been kind of coming back to it quite often on the charts mainly. And surprisingly, whilst we have been seeing oil decrease, and that's often the topic of discussion, we have also kind of linked in and discussed the chances of oil's price going up. Now, about 2 months ago, when we were talking about oil, we were actually talking about oil making new highs. This was around the time where we were expecting Russia and Saudi Arabia's oil production cuts, which were planned to be extended. We saw this as an attempt by Saudi Arabia and by Russia to make oil hit that $100 a barrel mark, and therefore we were actually talking about how high can oil go. But this obviously came before this kind of new period of weakening demand, which was highlighted first by the signs of a warmer winter, which obviously means the consumers and businesses are going to require less fuel to keep the businesses warm in the northern hemisphere. But this was a topic that then came to the forefront of the financial industry in relation to oil, and we did start to see that decline on oil. That said, when the war then broke out between Israel and Gaza, we once again went on the forefront of a kind of more bullish perspective in relation to oil, where we were then kind of talking about the potential for oil to go up even further, with us even referencing the chance of price going all the way up until the $150 a barrel mark. And this was largely as a result of the belief that if Saudi Arabia got involved, or if the conflict within Israel escalated to one which was more regional, then the chances of a massive oil shock around the world were very, very high. And this is why we were kind of more so talking about the bullish potential of oil. But in recent weeks, we've actually started to see oil just continue to slump. We haven't seen that regional escalation, and people are continuing to believe that these extended production cuts promised by OPEC Plus are just not going to materialize, with Brent crude oil falling 4% to $74.11 a barrel on Wednesday, which is the lowest level since end of June. And this continues a 5-day losing streak for the global crude prices, despite OPEC Plus's efforts. The voluntary nature of the extension of cuts made by OPEC Plus has left many traders unconvinced this will actually go ahead or have any significance, with the lower oil prices having boosted the global economy which has been hit by a slowdown, of course, as a result of these high interest rates, high levels of inflation, and we've seen that slowdown in major production hubs such as China as a result of that weakening global demand. With the failure by the cartel to drive the market higher being welcomed by Joe Biden, of course, and obviously many Western world leaders who are very dependent on inflation as a measure of his success and their success, but more importantly, the way gas prices within the US are perceived by consumers, as this is the key indicator of how consumers and individuals and voters see how the economy is doing, how they see inflation is affecting themselves, and therefore it's very important for someone like Joe Biden that's now going into his election year of 2024. So keep your eyes on that. And analysts and large oil producers will not want prices to fall further, with Russia and the United Arab Emirates meeting on Wednesday to discuss matters, with analysts recently noting that much of the cuts promised already were just extensions of existing plans, with African nations such as Angola already pushing against further reductions in output. And prices also fell further yesterday following bigger than expected US gasoline inventories. So definitely keep your eyes on this article. Keep your eyes on this topic as a whole, largely because oil is just such an important asset to stay on top of, and this constant news update that we're having in relation to the movement of the price of oil is of course important to keep in mind. That's all to talk about in reference to oil and the articles. Next to talk about, of course, is the charts, where first we're going to talk about the US 30, of course. Now, US indices as a whole are seemingly struggling at resistance. Now, most recently we've seen, US indices actually have a great level of bullish momentum, and this has largely been triggered by those lower than expected inflation rate levels, which have therefore triggered a kind of expectation of lower interest rates, as we explained earlier on. And therefore now what we're kind of seeing is this kind of great movement to the upside, as those lower interest rates will obviously benefit businesses within the US, which then can get those lower and cheaper prices for credit, expand their businesses easier, and therefore increase production. But as we're seeing here, we're not seeing a continuation of that bullish action at the moment. And yesterday, as we are seeing right now, price coming to contact with what seems to be a significant area of resistance and liquidity, as we've noted here. Therefore, the interesting thing will be how price will continue to react to this area. So if we notice how I've put down the Fibonacci extension kind of tool, of course, so it'd be interesting to see how price reacts to one of these Fibonacci levels. Obviously the 3820 is the closest, but price is seemingly forming this kind of very small and short kind of support and resistance kind of area. And so it'll be interesting to see how price may continue to bounce off these two areas. So keep your eyes on the US 30. Next to talk about though is the dollar, which has actually had some quite strong bullish momentum since around the start of December. Obviously we're not far into December at the moment, so obviously things can change, but we did manage to break out this bearish channel on the dollar, and we have seen this movement to the upside, which is in contrast actually to the expectations of lower interest rates, as this is what initially triggered this kind of sell-off and bearish movement to the downside for the dollar, which had initially been trending quite far, quite bullish for quite some time, since around the July period and all the way up until the beginning of the October period. And so it's interesting to see now that the dollar's making moves to the upside. It'll be interesting to see how the dollar though does react to the NFP figure on Friday this week, as that will heavily influence monetary policy making. So that's the one to keep your eyes on. What we could be seeing here is banks beginning to price themselves in for that NFP figure next week, therefore trying to get the highest possible price for a short going into this figure release. So keep your eyes on that. Next to talk about though is Euro USD, where we're continuing to see a push to the downside. Now, yesterday and I believe the day before, I had highlighted 7860 level as a significant area which we might see a reversal from, as we had started to see a kind of bearish move on Euro USD, where price had come up into the kind of overbought territory of the RSI, and price action had kind of become one which more so represented bearish kind of momentum, and therefore we did see a quite significant sell-off. As you can see here, this kind of slow move to the upside was then preceded this extraordinary move to the downside, as we had for quite some time just seen this really bullish momentum. And whilst we were seeing that bullish momentum, as you can see here, I was kind of highlighting when is it going to start retracing, but we didn't see that retracement. And when we started to see this kind of weaker bullish momentum, we started to expect a bit of a reversal, and we have now seen that short-term reversal, maybe, as we have seen that significant sell-off, and price is now possibly coming into contact with the level which price could retrace from, as we did draw out this Fibonacci level, and price had continually failed to make a significant move from all of these Fibonacci levels, but had respected all of them every single time it came into contact with them. So it would make sense for the 7860 level, alongside this strong area of liquidity, for it to be the most significant area which price would react from. So keep your eyes on that level. Next to talk about though is pound yen, where there isn't too much to say for it really. We have been seeing this kind of slow consolidation, slow move to the downside, but nothing of kind of interest to note, as price still hasn't made a significant move either way, and is kind of just continuing on this slow reversal that we did note and kind of predict when we noted this significant bearish divergence on the chart. So keep your eyes on that. Next to talk about though is Bitcoin, which obviously we've been highlighting most recently for its very kind of bullish momentum, where we have seen this kind of increased speculation for the positive side of Bitcoin, with the criminal court proceedings in relation to key Bitcoin and kind of crypto figures kind of coming to a close, as well as increased speculation that a Bitcoin ETF will be approved, as well as pricing in these lower interest rates, and therefore money moving into Bitcoin as a safe haven asset, has kind of triggered this significant move to the upside, where we've seen price move from the $20,000 territory kind of region all the way up until and very near the $45,000 mark, and now we're kind of sitting around this $44,000 mark to $43,000 mark, and price is kind of just consolidating. The question is though, will price retrace to the downside before continuation to the upside, as we are seeing very kind of overbought kind of price action, as we can see here on the RSI. Price came all the way up until the 85 point territory on the RSI. I can't pronounce it at the moment. RSI. So definitely keep your eyes on this, as we do have the potential for that retracement, and I have drawn out that Fibonacci chart just to kind of lay out which areas price could retrace to. So keep your eyes on this. Next talk about though is gold, which did spike incredibly high most recently, all the way up until the kind of and very near the $2,150 an ounce mark, but it did retrace greatly from that territory, and price is now sitting around the 7860 Fibonacci territory. But it's kind of hard to kind of draw out the key area where we would take a Fibonacci area from on the charts at the moment, just because price is so volatile, but overall gold has been taking a significant move to the upside, as people have been beginning to price in those lower interest rates for the USA. So keep your eyes on this. Next to talk about though is oil, which we did talk about in the second article, but I think it's important to cover on the charts as well. We are now in the oversold territory on the RSI, so maybe that's something to note. But price has moved so significantly to the downside that taking the most recent Fibonacci kind of area and tool, where we kind of noted that price was coming into contact with the 3820. prices moved so significantly to the downside that it is now nearing the minus 100% Fibonacci extension level. This is very, very significant as prices just moving overwhelmingly to the downside. So it'd be interesting to see whether we'll actually see a retracement on this, maybe, a break, hook and go. Maybe price will come into contact once again with this previous low of the market. So keep your eyes on this. That's all to talk about though on the charts. Lastly to talk about, of course, is the economic calendar, where we've got lots of data coming out today. Now, firstly, we will be getting Australian, Chinese, and French balance of trade figures being released, as well as that we will be getting the Swiss unemployment rate figure being released, so keep your eyes on that. As well as that, we will be getting the Italian industrial production figure and retail sales data being released, so listen out for that. As well as that, and arguably one of the most important pieces of data we'll be getting today is the Eurozone GDP growth rate. We are forecasting on a quarterly basis a contraction, but a small, kind of increase on the year-on-year basis. But definitely keep your eyes on this, as the Eurozone area has been struggling most recently as a result of these kind of high interest rates that the economies have to deal with, along with high inflation. So listen out for that. As well as that, we will be getting US continuing jobless claims figure and US wholesale inventories data being released. Along with that, the Bank of Canada's governor will be speaking as well, so listen out for that speech, along with the US consumer credit change figure to be released. And finally, we will be getting Japanese GDP growth rate figures and household spending figures being released. So listen out for all of that data. That's all from us at Wildwood Capital. We've covered a lot on the articles, lots on the charts, and lots on the economic calendar, of course. But as I've said, that's all from us. Have a great trading day this Thursday, and see you later. Bye.